All right, it is 2 minutes past the top of the hour, so we're going to dive in. My name is Kevin Prendergast. I'm a wealth advisor here with the Retirement Network. Joining me is Chris Dieckow, also a wealth advisor here at the Retirement Network. And what you see on the screen is our website. If after listening to our comments today, you have any questions or you'd like to review your personal situation, our website contains a scheduling tool. So you can schedule a phone call or a web meeting with myself, with Chris, by clicking the Get Your Free Assessment button and following the steps from there. Okay. So we are here today to review together the November 2021 segment rates as published by the IRS. The significance of these rates is that they tend to have a significant influence over pension lump sums with respect to the pension programs we most commonly encounter with AT&T folks. So that's the non-bargain program for a lot of management employees. That's the Midwest program for a lot of union employees here in the Midwest in particular. The legacy program, the mobility program. Those are just a few of the programs that we encounter most commonly. There are others. They have a lot of similarities, some subtle differences across those programs, but the one thing they tend to have in common is these interest rates. So the IRS publishes these rates a couple weeks into the month for the prior month. So that's why we're sitting here in December looking at the November rates. These November rates will be used to calculate pensions commenced in 2022. So if you've already retired from AT&T or you plan to retire from AT&T here in the next few days, these rates might be important to you, might influence the timing with which you commence your pension. Alternatively, if you plan to continue with AT&T beyond 2021, these rates may help you gauge the impact on your pension of continuing to work with the company in 2022 and beyond. So I'm going to share my screen and Chris will walk us through the latest and greatest rates.
All right, thanks, Kevin. So if we look at these interest rates, again, these are going to be what they call the IRS segment rates, minimum present value segment rates, guys. This is what they use to calculate the pension lump sums. So there's basically three interest rates if you haven't seen this before. Like we had just mentioned, what we want to look at is up at the top, November 2021. We use these interest rates for any pensions commenced in 2022. So if we compare these numbers to basically last year's November 2020, we can determine whether or not they've gone up or down. So these would be the key figures on this page that you probably want to look at. November 2020, which is highlighted, and then the top line, November 2021. So what we can see if we compare all three of these numbers, generally speaking, the interest rates have gone up. You can see going from 0.53 to 1.02, that's the first segment, and then 2.31, up again to 2.72, and then 3.09 actually ticked down just a hair, the 3.08. That one stayed about the same. So generally speaking, again, the interest rates have gone up. This is considered like a negative for the lump sums. They have an inverse relationship, so interest rates go up, then we would expect the pension lump sums to go down, all else equal. So, to the tune of, if you were looking to quantify that in dollars, to the tune of maybe 1 to 3% for lump sums, it's going to depend upon your specific situation, exactly, the degree to which, the value has dropped. So what we would suggest is that you pull up the Fidelity Net Benefits website and run the commencement. If you're not retiring this year, then run the commencement for 2022 and plug in these updated rates, plug in these numbers, 1.02, 2.72, and the 3.08 to determine and kind of compare the value for your lump sum, from this year to next. If you have any questions on that, we'd be happy to do it. Kevin and I do these all day, every day. So we're certainly very familiar with the Fidelity website, the estimate tool. We'd be happy to walk you through it. You can reach out through the website on our calendar to get that scheduled, to get that taken care of. But I think the takeaway for a lot of you all should be that this is not the end all be all to determine retirement. Kevin and I have both been having a lot of these conversations. I think there are a bunch of other considerations that you probably want to take into account. Number one, if you stay into 22, you continue to get paid your salary. I'd say number two is that you continue to receive the pension accruals albeit at, like a little bit less amount, maybe than it was in prior years, but it's still a positive. And then lastly, the 401k match. If you're contributing to the 401k, that's still a positive coming from the company. So we would suggest that you take all of that into account with your total picture if you're considering making the, that big decision to retire. All right, thanks, guys.
Good. And yeah, to Chris's point, this is the first time in a few years that these interest rates have moved higher. It's not the end of the world. The impact is 1 to 3%. So to put that in dollar terms, per 500,000 of pension lump sum, 1% would be a $5,000 hit, 3% would be a $15,000 hit. If you were going to work for AT&T beyond 2021, you probably have a salary that's well in excess of those numbers. Just a few months of salary will probably kind of earn that back, so to speak. You will continue to receive pension accruals. Management employees are seeing those pension accruals a bit less generous starting in 2022, but it's still something. It's still a positive, just like Chris said. And some of you are under 55, so there's these little discounts that go away as well when you're under 55, so that can be a positive. So there are definitely factors that will allow you to kind of earn this back. This is not the end of the world if you're staying with the company beyond 2021. But if you are already retired or you're retiring soon and your program allows, not every program allows, probably a good idea to begin or commence your pension lump sum this calendar year. Again, if your program allows. Hopefully this is helpful. Let us know if you have any questions. You can reach out to us through the website. You can reply to any of our emails. We do monitor that inbox. Otherwise, have a very safe and happy holiday season. Bye.